So we've delivered a 7% growth in distributions. It's in line with the guidance that we gave the market of growth between 7 and 8%. It is on the lower end of our distributions, I think, with a bit of bad luck, in that we picked up some historical council billing inaccuracies and in one of our portfolios, and we've had to create a provision of around 12 million rand for that, which had we not had to do that, that would have, earnings would have been above 8%. For us, it's been a bit frustrating because other than that, it was a very, very strong set of results. If you look at it operationally, vacancies have been contained at 4.7% of GLA, which I think in this environment is a very good outcome. We had like-for-like net property revenue growth of 6.1%. We achieved positive reversions across all three sectors, sitting at 9.6% on average, but the retail sector was up by 13.6%, which is really an excellent result. In any market, in this difficult market that we're in, I think we really have done well there. And then you've got 44% of leases now expiring in 2019 and beyond. So you're seeing this ongoing lengthening of the lease profile. In Vukile, the retail portfolio is now sitting at 51% expiring beyond 2019. So you can see that really the health of the underlying business is very, very strong. It's in a good position. A couple of other operational highlights for us. We've made very good progress on the energy management initiatives that we've been looking to put in place. We've achieved some savings there ahead of budget. And then also on the non-GLA side, which we spoke about previously as being a core competence that we need to develop. A lot of the building blocks are now in place, and we'll hopefully start seeing the benefits of that in future years. During the period under review, we acquired 3 retail shopping centres at a total cost of 846 million at a combined yield of 8.6%, a blended yield between them of 8.6%. We also signed up the deals on 2 regional mall developments with the preeminent developers Flanagan and Gerrard. That's to take a 25% stake in Springs Mall and a 33% stake in Tivani Mall in Toronto. Both are very exciting developments. They are small regional centres. Springs will be about 43,000 squares, Toronto about 50,000 squares. We did a 1.1 billion rand capital raise in May of this year, and 600 million of that has been set aside in an interest-bearing deposit for those developments. So in fact, we're taking no equity market risk on those developments for the long term. There's a 2-year delivery. So we're quite excited with where that's going to end up. Gearing, we remain conservatively geared. We're sitting at 28%. Just under 83.5% of that debt is hedged. So we have a very conservative approach to a rising interest rate cycle. And then a very exciting development for us in the last few months is we've just achieved a level 3 BEE rating, which I think is of the highest in the property sector, and I think really shows our commitment to transformation in the business. What has worked very, very well for us has been the Encha transaction in terms of the equity tap structure. So Encha today own 8% of Vukile, around 8% of Vukile. What's significant about that is that when the Encha deal was done, Encha owned, I think, 5% of Vukile. In that space, Vukile has doubled in size, more than, and their ownership has gone up, and that's because of the structure of the equity tap structure, where they would get a disproportionate share of any future capital raises in order to grow their stake. So that, I think, has been a big contributor to the level 3. Another highlight of the results, I think, would be the strong cost containment. If you have a look at through the presentation, you'll see that our cost ratios, at a total cost ratio as well as excluding government services, in fact are at levels below where they were in 2012. So you can see sort of a real tight focus on the cost is paying off. So I think the summary from an operational point of view is we are very happy with the performance of the portfolio, really in good health. A bit of bad luck on that billing. We've taken the conservative route by creating a provision. We'll sort that out in due course with council, but there should be no nasty surprises going forward. in respect to that billing because we've taken that conservative approach now.